Hello students, welcome to the lecture series on financial management. Today in this lecture, we will take up the typical illustrations based on capital budgeting techniques. So, our today's discussion is on the typical illustrations which we face in the examinations for solving and applying the techniques of capital budgeting. So, when we apply these techniques, we need to ascertain step by step how to compute the cash flows, how to find out the present value factors and how to accept or reject the proposal. So, generally typical examples of capital budgeting are based on ascertaining the net present value, on the basis of which we have to decide whether we have to buy a machinery or not, whether we have to go for the initial cash outflow or not, and we also decide whether to replace a machine or not. There are certain mutually exclusive projects, that is either to accept machine 1 or 2. So, under all these criteria we are using the capital budgeting techniques and we apply the suitable technique to solve the questions. In our previous lecture we have learned about various techniques of capital budgeting such as payback period, such as discounted payback periods, which is a improvement over payback period as it does not consider the present value of the cash flows. We have learned about accounting rate of return, but it is having a very limited utility as it is again not considering the present value or the discounting factors of the cash flows. We have already learned about the net present value, which considers the present value of the cash inflows, that is we are using the discounting factors to find out the cash inflows in the present value. So, first of all the step 1 will be to ascertain cash inflows, then to find out their present value, then we need to ascertain the discounting rate of return, which is the most suitable rate of return to discount the cash flows, and we will accept that proposal which is having higher net present value or higher PI. PI is the ratio or the relationship between the inflows and outflows, that is also known as benefit cost ratios. So, all these techniques we are going to use in our typical examples. So, we will take up one typical example first, we will understand what is being asked in the question and then we will solve it step by step. So, let us take up the typical example 1. A company is considering replacing an old machine which is fully depreciated for tax purposes with a new machine costing 40,000. The new machine will be depreciated over its 8 years lifetime to 0 on a straight line basis method. It is estimated that new machine will reduce labor cost by rupees 8,000 per year. The management believes that there will be no change in the other expenses and revenue of the firm due to the machine. The company requires an after tax rate of return at the rate of 10%. The tax rate is 55%. The company's income statement for the current year is given in the form of information. Should the company buy the machine? So, here first of all it is said that there is a old machine, for the purpose of tax it is depreciated fully, for the purpose of tax it is fully depreciated, and the new machinery's cost is given, that is initial outlay is given as 40,000, life of the asset is given as 8 years. We have to use the SLM method to ascertain the depreciation. Then we have also been given another information where our machinery will reduce the labor cost by 8,000. So, it will also increase the inflows, rest there will be no change in income and expenditure, rate of return is 10% and tax rate is 55%. The other information, that is financial informations, are given, which are income statement for the current year is sales 5 lakh, cost is given as material 1 lakh 50,000, labor 2 lakh, factory and administrative overheads 40,000, already given depreciation is 40,000. So, total expenses is or the cost is 4 lakh 30,000, net income before tax is 70,000, tax at the rate 55% is given as 38,500. So, earnings after tax is 31,500, it is being given. So, we will solve the question. Here now we know that depreciation is given as 40,000, and one more depreciation we can compute is, that is by applying the formula where cost of the asset divided by life of the asset, we can get the depreciation for the new asset, that is 40,000 divided by 8. So, 5,000 will be the new depreciation which will be added. With purchase of new machinery, we have gained the efficiency. So, labor cost has reduced, which is also being given in the information as 8,000 per year it is reduced. So, from 2 lakh we can reduce the 8,000 rupees. So, we will again solve the question and find out our workings as sales is 5 lakh, material is given as 1,50,000, labor is 1,92,000, from 2 lakh we have subtracted 8,000, factory and administrative overheads are given as 40,000, depreciation on present machine is 40,000 as it is depreciated fully, and on new machinery 5,000, it is being computed using the formula, that is cost of the new asset 40,000 divided by 8, that is 5,000 we have ascertained. So, total depreciation is 45,000. Net income before tax now would be 73,000. Tax rate is 55%. So, applying 55% rate on 73,000, taxes we are getting as 40,150. Earnings after tax will be 73,000 minus 40,150, that is 32,850. Add back the depreciation. Here the depreciation given would be 40,000 plus 5,000, that is 45,000. So, estimated cash flows are 77,850. Now, find out the previous cash flows. It will be, we know that in the question we were given the earnings after tax as 31,500. We will add back the previous depreciation of 40,000. So, present cash inflows before opting for this decision of going for new machinery 71,500, and now we are getting the cash inflows as 77,850. So, differential cash flow we have got. We have to apply the differential technique to ascertain the cash flow, that if we are going to buy this new machinery, how much inflow is increased. So, it is increased by rupees 6,350. Differential cash flows we have to ascertain, that is before going for this option we were having the inflows as 71,500, and with excising the option of this replacing the machinery, we are getting the additional cash inflows, that is 77,850 minus 71,500 is equal to 6,350. Now, we will ascertain its present value. Present value of differential annual cash flow of 6,350 for 8 years at the PV factor 5.335 will be 6,350 into 5.335. So, our present value shall be computed as 33,877.25. We will subtract the cost of new machinery, it is our initial investment, that is 40,000. So, net present value we are getting is negative 6,122.75. It is negative value, present value is coming less or in minus. So, we should not buy this machinery, though there is a differential cash flow in positive terms, but when we apply the present value of the inflows and subtract it from the cash outflows, what we are putting it as an investment is a higher blockage of the fund than what we will receive in the upcoming 8 years. So, we will not go for replacing this machinery, and this way the net present value techniques helps to take up the decisions of the long term investment using the PV factors and discounting techniques. Now, we will take up another typical problem in which we need to apply the capital budgeting technique to ascertain the decision whether to go for buying a machinery or not. A hospital is considering to purchase a diagnostic machine costing 80,000. The projected life of the machine is 8 years and has an expected value of 6,000 at the end of the 8th year. The annual operating cost of the machine is 7,500. It is expected to generate revenue of 40,000 per year for 8 years. Presently, the hospital is outsourcing the diagnostic work and is earning income of 12,000 per annum net of taxes. Required whether it would be profitable for the hospital to purchase the machinery, give recommendation under net present value and profitability index. The PV factors at 10% given below: first year 0.909, second year 0.826, third year 0.751, fourth year 0.683, fifth year 0.621, sixth year 0.564, seventh year 0.513 and 8th year 0.467. We can look into the discounting tables to ascertain this value, or else how we can derive this value: 1 divided by 1.1, then we will use is equal to on the calculators, and number of times we will use is equal to, these values would be reflected in our calculators and we can use it. Again we will read the questions to get the information required for solving our question. First of all, the outflow of the cash, that is initial investment, would be rupees 80,000, as the diagnostic machine is costing us 80,000. If we are going to buy it, this initial cash outflow will be there. So, right now we are facing a problem whether we need to purchase this diagnostic machine, or should we continue to go for this diagnostic work being outsourced. So, if the hospital is considering to purchase this machinery of 80,000, they need to ascertain the net present value. For that, the projected life is given as 8 years. Scrap value, that is salvage value, at the end of the 8th year of this machinery will be 6,000. Annual operating cost is 7,500. Revenues generated are 40,000 for 8 years, and if we purchase this machinery, we are losing the income of 12,000 which we are generating right now by outsourcing the diagnostic work. So, this commission income won't be coming to the hospital. So, these are the set of information and we will solve our questions. First of all, we will find out the cash inflows. So, first of all, we are given the revenues as 40,000 will be the revenue which we will receive every year for 8 years. Operating cost of 7,500 we will incur every year. Tax rate, we assume that it should be 30%, as no information for tax rate is given. Then we will add the depreciation. Depreciation again we can compute using the formula as cost of the asset minus the salvage value divided by the life of the asset. This way we can ascertain it. Then commission which we have lost is after tax. So, first of all, after tax cash flows would be computed, then this income, commission income, will be reduced out of it. So, net cash inflows after tax we can compute. So, let us solve this question. Sales is 40,000, less operating cost 7,500, less depreciation 9,250. It is computed using the formula 80,000 minus 6,000 divided by 8. Earnings before tax will be 40,000 minus 7,500 minus depreciation 9,250. So, it will be 23,250. So, applying 30% on 23,250, we are getting tax as 6,975. So, when we subtract tax from earning before tax, we are getting earning after tax, that is 16,257. We will add back the depreciation of 9,250. So, we will get the cash inflows after tax per annum, that is 25,525. We will subtract the loss of commission income of 12,000 which the company is foregoing out of the outsourcing income. So, net cash inflows after tax per annum will be 13,525. This will be for 7 year. For 8th year, the inflow will change. Net cash inflows after tax per annum is 13,525. Add salvage value of the machine 6,000. So, net cash flow in the 8th year will be 19,525. So, we will present a tabular format and find out the present value of cash inflows. From year 1 to 7, as we have mentioned in column 1 here, years 1 to 7, the cash flows after tax is 13,525. PV factors at 10% will be 4.8671. So, from year 1 to 7 we will add the PV factors, that is 4.867, multiply the PV factors with cash flows after tax. So, we will get the present value of cash inflows as 13,525 into 4.867 is equal to 65,826.18, and in 8th year 19,525 into the PV factor of the 8th year, that is 0.467. So, we will get the present value of cash inflows as 9,118.18. So, our present value of cash inflows will be 65,826.18 plus 9,118.18 is equal to 74,944.36. We will subtract our initial investment, that is cost of the machinery, as 80,000. So, we will get the net present value as negative 5055.64. Again we are getting the net present value as negative. Inflows are lesser than the initial investment. We will ascertain profitability index also. The formula of PI is sum of discounted cash inflows divided by present value of cash outflow. So, we have computed the discounted cash flows in our previous step, that is 74,944.36 divided by 80,000 is equal to 0.937. So, the advice which we are going to give to the hospital is that since the net present value is negative and PI is less than 1, therefore, the hospital should not purchase the diagnostic machine, and we have given the assumption of tax rate to be 30%. Now, student, we will take up another simple example to understand whether we should go for the cash payments ad hoc or to go for the option of making the installment payments. Again, we will use the net present value technique to find out our decision finally how to proceed for the payments. A doctor is planning to buy an X-ray machine for his hospital. He has two options. He can either purchase the machine by making a cash payment of 5 lakh or rupees 6,15,000 to be paid in 6 equal installments. Which option do you think the doctor should exercise, assuming the rate of return to be 12%? Present value of rupees 1 at 12% rate of discount for 6 years is 4.111. So, here the annuity for the 6 years at 12% is already being given as 4.111. There will be equal outflow of the cash for these 6 years, that is 615, we will divide by 6. So, equal outflow would be there. So, we can simply multiply the outflow into this annuity to ascertain the present value of our decision. So, let us move towards the calculation aspect. Option 1 says that cash down payment of 5 lakh is to be made. So, cash down payment 5 lakh is the first option. Option 2 says annual installment basis. Find out the annual installment. If 6,50,000 is the total amount of outflow which we have to make in 6 years, for each year how much is being the installment? 6,15,000 divided by 6, that is 1,02,500 will be the annual installment which the doctor needs to pay. Present value of 1 to 6 installments at 12% will be, the annuity at 12% is being given as 4.111. So, what we will do to ascertain the present value of installment, we will multiply 4.111 into 1,02,500, that is annual installment. So, the present value will be 4,21,378. So, if the present value of 1 to 6 installment is 4,21,378 and it is lesser than the cash down payment of 5 lakh. So, we will suggest that doctor should buy machine on installment basis, because if he is paying 1,02,500 in 6 installments for 6 years, its present value, that is in today's term what he is paying out of the pocket is 4,21,378, which is lesser than today's 5 lakhs cash down payment. So, this to at the rate of 12%, when we discount the annual installments, we are at a beneficial position to go for the installment payment. So, this is the method by which we can ascertain whether we should go for installment payments or to make the cash down payments. So, we can understand here that net present value techniques could be used for n number of decision making criteria, where we have to work out whether the present value of our inflows are higher than the present value of outflow and can take up our decisions accordingly. So, we have learned the two typical examples based on net present value method. In our upcoming lectures, we will take up the another typical examples as well as the internal rate of return technique. Now, students, we are summing up our discussion of today. In today's lecture, we have learned the typical examples to be solved using the net present value technique. We have taken up the step by step method to find out the cash flows. We have ascertained differential cash flows, we have ascertained the net present values of the cash flows and take up the decision as to go for buying a machine or not, going for the installment payments or not, and we have learned where and how to apply these techniques. With this, we are ending up our discussion of today. Hope there has been a clarity on the method of solving the questions based on net present value. Thank you.